This is a talk introducing Chapter 2 about the usage of the terms debit and credit in accounting in recording business transactions. These are terms not used in Chapter 1, but will dominate going forward. So we have a very critical transition here. By the way, debit and credit are terms that can be used as nouns, verbs, adjectives, depending upon context. Here's a high-level agenda. Chapter 1 talked about the equation increase and decreases. Chapter 2 is about recording transactions. It could be entitled Basic Bookkeeping. In Chapter 2, plus and minus in terms of debit and credit is largely ignored. We're going to pick up that subject. Chapter 2 also talks about the accounts being introduced and introduces to a T account pretty effectively. Left-hand side, right-hand side, in which we can see how transactions are recorded. The terms debit and credit themselves, and it does tell you that debit means left and credit means right. That's fine. Finally, there's a need to integrate plus and minus in terms of debit and credit with increase and decrease. Now that requires skill and practice. Brief word of caution, the increase and decreases to the equation in Chapter 1 and what I'm going to discuss in Chapter 2 about plus and minus do not simply say, oh yeah, plus, increase, negative, decrease. No, that's what you have to learn in Chapter 2. We're going to learn that the context of debit and credit can both mean increase and decrease, and the concept of negative and debit and credit can both mean decrease and increase. That will be the learning challenge. First, we need to review the depiction of the accounting equation as presented in Chapter 1. This is the big picture of that introduction. And then literally pivot away from one specific illustration of that model. Here's a summary graphic of the equation big picture of Chapter 1. Two sides, assets and liabilities known as equity. Resources possessed by an entity or company, and the claim on those assets on the right-hand side. Beneficiaries to whom that wealth or assets ultimately belong. Whatever transactions we record, they have to stay in balance so that the left-hand side equals the right-hand side. Okay. Now, we'll not be diving into the various accounts initially, which are shown. There's no issue there. We're going to focus on the arithmetic instead. So, let's look closely at the math signs in this graphic, such as in transaction 1. Cash is invested by the owner. Cash goes up in the entity, and we increase the owner's capital account. Plus, plus. Or another transaction, as cash expenses are paid in transaction 6. Cash goes down $3,200, and our equity category goes down by charging expense accounts. Both sides of the equation go down, minus, minus. Now I want to show you a less busy view of the Chapter 1 big picture, taking away the accounts. So as assets are increased, this is an overview of Chapter 1, as assets are increased in total, we showed them in Chapter 1 by a plus sign, and we had increased either liabilities or owner equity as total assets are increased to keep the two sides in sync. Plus, plus. Likewise, as assets are decreased in total, the graphic of Chapter 1 showed them going down with the minus sign and showed a reduction in the accountability side, the right-hand side. Possessions go down, claims on those possessions must also go down. Now, to bridge Chapter 1 and Chapter 2, we have to make an adjustment to the math we see in the right-hand side of the equation. No change to the right-hand side. Assets increase, assets decrease. But we have to make a change in this side here going into chapter 2. We cannot use this plus plus and minus minus graphic. And the first thing I want to concentrate on is how the two worlds of accounting are increased. In other words, when we increase assets, how we increase those on the left-hand side and increase accountability on the right-hand side. Now, the accounting worlds reported upon in the equation are opposite in nature, economically speaking, and can be viewed as mathematically signed differently. One is positive and the other as an offsetting negative. So when we look at how assets are increased, we have to bring this model in. That assets are a positive world and liabilities known as equity, the claim on assets, are a negative world. They pull against the assets that are in the entity when they're increased. That's the basic learning that I'm going to deal with. Positively signed assets when they're in, negatively signed claims on assets pulling against the assets held or possessed by the entity. And when assets are decreased in total, we've got to bring in a negative, which is completely logical. But when we decrease the claims, as assets are decreased, we have to bring in a positive sign here that is not intuitive as assets are decreased in total on this right-hand side. So again, it's the right-hand side that we're making the adjustment in terms of signs. Here's a brief graphic on Chapter 1 Revisited. Again, no issue on the left-hand side. Assets are increased with a plus, but liabilities known as equity, when they're increased in a negative sense, a negative sign. Debits increase assets, credits increase liabilities or owner equity. I want you to initially learn debit and credit in Chapter 2 from the point of view of the categories of assets, liabilities, or owner equity. Possessions of the assets, legal claims against them, owner claims against them. And only secondly, apply debits and credits at the account level. Similarly, when assets are decreased with a negative, we'll bring in a credit, which is opposite of debit. That's logical. But over here, when we decrease the claims on assets, as assets are decreased in total, we have to bring in a positive debit, which counters the negative nature of this entire side. As liabilities and equities are increased, it's a negative world as opposed to a positive world. Debits and credits are contrasting in accounting, and that's how you need to view them. Again, this is not intuitive and not spelled out in your chapter. Two different worlds. Possessions held, obligations to pay back those possessions. They are in contrast and economic tension with each other. Now, a replacement model I want you to view is, and this is not in your chapter, is a standard zero number line. Zero in the middle, plus numbers, minus numbers. They offset each other to zero. Why is zero important? Zero is the net worth of the entity. Any assets possessed by an entity are claimed by others and do not ultimately belong, or they ultimately belong to others and not the entity itself. All I have to do is make one adjustment to this. We have to invert this. I'm going to put positives over here and negatives over here. So pivoting that number line to properly align it with the accounting equation, I've got positives on the left representing assets, negatives on the right representing claims on assets when assets are held by the entity. So this inverted number line accounts for magnitude increases as assets increase, claims against them increase. Whether a company has $1 million of assets and $1 million of claims against them, or $3 million of assets and $3 million of claims, they stay in balance. There's a symmetry there in terms of magnitude, but not direction. Assets positive, claims against them negative. As the left-hand side increases with positive numbers, the right-hand side increases in the opposite direction in a negative sense, claims against those assets. If you use this model to overlay the accounting equation, when our assets are possessed on the left, are offset by claims against them on the right. Positive, negative. When assets are increased and exist within an entity. In effect, this inverse number line, as an overlay, I'd like you to concentrate on the fact that instead of saying assets equal, mentally think assets are offset by claims against assets. And again, first envisioning the increase in assets, we can call them populating debits, positive sign on the left-hand side, offset by populating credits or negatives on the right-hand side. So a symmetry in magnitude, but a difference in direction. And again, why is zero important? Zero is the net worth of the entity, not to be confused with net worth of the owner. Just bringing everything on the right-hand side over to the left-hand side, we can see how if we completely offset assets with their claims, the result is zero. Possessions by the entity, claims against them, netting out to zero. Entity net worth, that's our focus. Different than owner net worth, that's just assets minus liabilities equals owner's equity. Owners try to maximize this owner net worth, but we're talking about the entity net worth, zero in total. Hence, the focus on zero in this number line, entity net worth, that's the focus. Whatever's possessed is always offset by beneficiaries. Now, to introduce debits and credits in Chapter 2, I'm going to introduce two colors. Debits, I'm going to call red, and credits, I'm going to call black. So debits are red. They represent the resources or assets of the company. Credits are black because they represent the beneficiaries or those who have claims against those assets. Any assets in has to have an offsetting claim in the equation. So debits are red, credits are black. So as we populate assets with positive debits, we populate liabilities and owner's equity with negative credits. And there's a representation. Debits are always positive, credits are always negative, no matter where they appear in the equation. This is not covered in your book. This is the underlying relationship of debits and credits, the relationship established 500 years ago by an Italian monk who documented, in effect, modern day accounting as we know it, using the terms debit and credit. Now in reversing mode, when we decrease assets in total, we'll decrease them with a credit and we'll decrease the claims with a debit. Decrease assets with a credit, negative. Decrease claims with a positive debit. Again, this is not intuitive, but remember that in populating the equation, we first start with getting assets in an entity. We're populating those claims with a negative credit. And so to reduce assets, reverse it, reduce assets by reducing the claims with a positive debit, reducing the assets themselves with a negative credit. This discussion will continue in a separate video. The basis going forward is that we're in a contrasting, offsetting relationship. Debits on the left dominate, credits on the right claim, they offset each other in total. Positive, negative, netting out to zero, the entity net worth.